Hello, good afternoon, or good morning even, and a very warm welcome to you all. Thank you for joining us in this follow-up BKL webinar on the coronavirus business support. First and foremost, these are extraordinary times, and we hope you, your loved ones, are safe and well. Thank you for joining us in record numbers for our original webinar on coronavirus business support last month. Since then, there's been a number of government announcements and updates. So today we want to have a look at the following key areas and see if we can expand on what we said last time. So we'll focus on the self-employment income support scheme, the coronavirus job retention scheme, and probably the most controversial, the coronavirus business interruption loan scheme. I think it'd be fair to say hasn't worked as well as it might, and there's been a number of changes there. There's also been a number of new announcements, so we'll talk through the bounce back loan scheme, the coronavirus large business interruption loan scheme, the future fund, and additional support for individuals. So we're going to whip through that. We'd also like to cover many of the questions that unfortunately we didn't have time to answer last time. So we've had a look at all of those, and once we've run through these areas, we'll go through all of those questions. But please do, if you've got any further questions today, do email them over to us. We'll do our best to answer them today, time permitting. If not, we will print them out and come back to you all via a separate email later. So we'll do our best to answer them as best we can. Now, I'm delighted, hopefully, to be joined by my crack coronavirus team of Daniel. Are you there online?
I am. Hi. Good morning, everyone.
Good. We've got Chris.
Yeah, good morning, everyone.
You, and we should also have Wendy with us today.
Hello, hi.
Good, so we're all on board. You'll appreciate we're all safely ensconced at home, like I'm sure many of you. So we very much hope the technology holds together for you. So we'll get cracking then. So to start with, we're going to look at the self-employment income support scheme, which is now up and running. Chris, do you want to talk us through the updates and what you can enlighten us on this morning?
That's fine. As essentially as Tony's alluded to, it's up and running. This week, individuals will started to receive their emails coming from the revenue. If people haven't received an email, that's okay. They can still use the eligibility checker, which is also up on the gov.uk site. It's a very simple process for those agents out there. There's not going to be too much for you to get involved with, perhaps providing UTR numbers to clients. Essentially, the individual goes on to eligibility checkup, puts in a UTR number, national insurance number, and you get an instant result as to whether they're eligible. And the individual will be given a date to when apply. Once they go on that date, they will have to go on via their government gateway account. So key point is making sure everybody has that government gateway account. If you are Uber, say proactive, I'd suggest getting that sorted as soon as possible. Actually making the registration, sending emails out to clients, etc., to get that done. Say soon as. When the individual logs on to their government gateway, all they will be doing is putting in their bank details and putting in their bank details and signing away essentially that they are affected. Their business has been affected by Corona. And that's it. The revenue will do the calculation and make payment within the 6 days. So nice and simple. The other proactive point for the agents is obviously the fee protection. We keep saying it, but we are obviously expecting the government to recoup some of this money, and inquire is the logical way of dealing with it.
Okay.
So moving on, job retention scheme. There's a couple of key points that have been released. The major one, which we didn't cover, I believe, on the last update, was that office holders and directors confirmation that they can be furloughed, they can carry out duties in relation to the Companies Act, and equally, if you are going to furlough as an office holder director, a suitable minute should be made. So fairly straightforward. The more complex issue arising with it is that in a lot of cases we see an annual pay period. So company directors that pay themselves annually and typically towards the end of March. And this will cause an issue if the RTI submission for the annual payroll hasn't been made as of the 19th of March. The revenue in this instance, you go on to make the claim. and it will just come up ineligible straight away. Or if you've got employees that are eligible, but and you try to include the director, you have an employee count or a head count for who you're making the claim for. If you include the director, it will more than likely say the whole scheme is ineligible. So you'd have to just knock it down to the employees. The point with this to note, at the moment, there is no appeal process on this. The legislation is clear that it has to, the RTR submission has to have been made in 1920 and before 19th of March. So as it stands, that is it, and that we don't believe the revenue are going to budge on this. I don't know for sure, it may move, but my gut feeling is they're not going to move on this point. So a lot of people missing out there. Other updates, one that was last week, I believe it came in, it was a change of wording that's just sort of thrown in there. I don't know how many of you guys are out there would be affected, but the employee transfers under a 2P wording was slightly changed to tweak to say for employees transferred after 28th of Feb, as long as the 2P or PY succession rules apply, then they are eligible. We haven't seen any issues as yet regarding the system throwing this out as ineligible. I would recommend, if you are getting problems, I mean, with this and other instances, I've been on the phone with the Revenue this morning, one particular case, they will deal with queries over the phone. So if you feel that a company is eligible for the scheme, do call the Revenue up and they can amend that way. They won't take claims over the phone, but in some instances it will throw out an error. So do call the Revenue up. And my gut feeling again is on 2P, this could be one that could throw up an error. So you may need to call the Revenue. And lastly, just accessing the portal in general, as for those that have done it, surprisingly, it is quite easy to do. We haven't had any big instances of crashes as yet. It's quite simple to put your claim through. You do need to make sure the workings, I think, have been kept, and you've got detailed workings, because the calculator is not the easiest. We do have the BKL calculator on our website, or ask your contact at BKL if you need that. I'd suggest working through that calculator, keeping all the workings, and just being mindful of any inquiries going forward. I think the only other bit I've made on that slide actually was made the point that you, in terms of the actual claims, just do bear in mind you can only claim 14 days ahead. So we had a lot of people trying to claim for May and June, or requesting the funds for May and June. If you don't run the payroll till the end of May, you've got to wait for that. You can only claim for that 14 days ahead. So you're looking around the sort of 14th, 15th of the month that you can start claiming for that month ahead. But it still should give plenty of time. The Revenue are turning round the claims relatively quickly, as we see, and payments being made within the 6 days. So from a cash flow point of view, you can make it early and get the money in pre-payroll, hopefully.
Okay, thanks for that, Chris. You touched upon TUPE there, and notwithstanding there's a transfer of business, you can still apply for the relief, albeit you flagged up the point that might give you computer error, as it were, when you try to submit the claim. Are you finding you can get through to HMRC on these applications at the moment?
I think, again, they've put a lot of resource on this. So, you know, we're trying to get through to HMRC on various other tax compliance matters, and we can't, quite simply, because they've all been moved to this. So you'll go through to the helpline, put in a couple of you know, automated press the numbers, etc., and they generally answer within 10 to 15 minutes. Okay. But to be clear with, I think to be clear with it, Tony, it's just don't try and claim online. It is queries. Yeah. You may get asked, you may get told it's going to go to a technical advisor, and on that instance, yes, we're seeing that it's a 48-hour, sometimes longer response time. But where they can, they're being very helpful.
Okay, good to hear. Okay, thank you for that, Chris. There is, as always, a human aspect to the job retention scheme, etc., and having to furlough staff. And Wendy, you're going to give us a quick update on the HR aspects here.
Yes, hello. So in the last webinar, I did give quite a detailed explanation of redundancies. And since that time, there's been a little bit of clarity provided by the government and HMRC in terms of their stances towards this. I'm also hearing from clients that they're starting to consider redundancies post-furlough or even before furlough. So I've got some key bits of information here that you need to think about. Obviously, There is a consultation period that you do have to observe according to the government. The government has made it very clear it expects all employers who are considering redundancies to honour the provisions put down in law for consultation. So obviously if it's less than 20 people, it could be up to 1 or 2 weeks. It's what's fair and reasonable. And the other consultation periods are provided there for you for other amounts of redundancies. So consultation involves communication up front about the potential for redundancies, a consultation period to discuss the situation, if appropriate to apply objective selection criteria fairly, and to look for alternatives to losing people. You can make furloughed employees redundant, and you won't need to repay the subsidy from the government if you've claimed that for those people. One thing I did mention at the last webinar is you have to be very careful about deciding to make some people redundant versus furloughing others before the end of the furlough scheme. And I just want to let you know that I'm hearing of individuals who are suing their employers, their previous employers, for having been made redundant in that circumstance. So exercise extreme caution if that is what you're contemplating doing. So again, I've given the statutory redundancy pay calculator there for you so that if you need to work out what your liability is, you can find out there. There is a provision under the Trade Union and Labour Relations Consolidation Act, which covers special circumstances. It's S188. It's not clear as yet whether coronavirus would constitute a special circumstance, but essentially it's sometimes a clause that employers use when it's not reasonably practicable for them to observe the consultation stipulations. However, I wouldn't rely on that. And if you are waiting until the end of furlough, which is beginning of July, you have got time to enter into a fair and reasonable consultation period, because the cases that I'm hearing about, it's about the fairness of the process. And if you can't prove that your process was fair, you're raising liability for your organisation. So it was really just a really quick reminder about redundancies. And if you need any help or advice on that, we'd be happy to oblige.
Okay, thank you for that, Wendy. Moving on then, probably as I touched upon before, the most controversial aspect of all the elements of the government support has been the coronavirus business interruption scheme. I think in principle, it sounds very helpful. I think the reality is it hasn't worked as well as it should. So there have been a number of changes, and Daniel, I think you're going to talk us through where we're up to at the moment and some of the practical experiences we've had for our clients in trying to obtain these loans.
Yeah, that's right, Anthony. Thank you. Just as a very quick reminder, because this scheme was around, and for those that were at our previous webinar, we went through it then, but as a very quick reminder, it's financial facilities, loans, overdrafts, invoice finance and asset finance for up to £5 million, and facilities can last up to 6 years for loans and asset finance. The government provide an 80% guarantee to the bank, and the government pays the interest and the fees in the first year. So that's just as a reminder.
Okay, and just to remind everyone, if you didn't catch our previous webinar, it's on our website, or we can send you a copy if you would like to revisit that at any point, as are all our previous webinars. But thank you. Those are the headlines. Moving on, Daniel.
So where are we up to? As you said, Anthony, hasn't gone down particularly well, and these statistics came out this morning. As of yesterday, as you can see, there's about 63,000 completed applications, of which 53% were approved. For those 30-odd thousands that have not been approved, they could be they are a mixture of outstanding applications that are still being considered by the banks, those that have been made and then sort of withdrawn by the applicant, and more importantly, those that are denied by the banks. And there is no statistics as to how many of those 30,000 are outstanding versus denied. They're getting about, last week they got 9,500 new applications. It's not a huge number, You can see that they've lent 5.5 billion, which is an average of 164,000. But you'll see in a minute, compared to the bounce back loan scheme, that's not a huge amount of money. What's more important is how many inquiries have not converted to applications. It's quite a lengthy application process, and the banks are asking for lots of details. They're asking for financial forecasts and obviously lots of historic and up-to-date financial information. And it's quite a sort of laboursome process to apply for it, and it's not a sort of online form. So people are having to get in contact with the banks, and we know that the banks are encouraging, if that's the right word, a number of people to not actually apply because they're saying up front that their applications won't succeed. We've got no idea how many inquiries weren't converted to applications. 3 weeks ago, someone put forward that number is about 300,000, but of course it's a guess and we haven't seen anything since.
Okay.
Where are we up to with CBILS? There's now 63 accredited lenders. They're all on the British Bank website, a British Business Bank website. Most banks are only lending to existing customers. There's various reasons for that. One is simplicity, they know their customers better, and there's another about the amount of CBILS they're supposed to be lending. So it's not generally great to go to another bank if your bank doesn't turn you down. There are, however, a number of alternative lenders up there. There's specialist invoice finance and asset finance lenders that are there. There's also, for example, and I'm not advertising one over any others, but to give an example, Funding Circle is there, who are obviously not a bank and might be a credible alternative lender for those people who think they have got a good application to make where their bank are not encouraging them to proceed with the application.
Dan, if I could ask, how does the application process compare under CBILS to if these were normal circumstances and you were going to your bank for a loan?
Not necessarily any different, really. I think that a lot of people, I mean, you ask 100 people and there'll be some people who say it's much simpler and some that will say it was much more difficult. In theory, it shouldn't be any different. 12 years ago, we said to the banks, you've got to start lending responsibly now, and ever since then, they have been asking for lots of information when they're considering applications. And the fact that the government is supplying 80% of the guarantee doesn't really interfere with that. The whole point about the CBILS, the business interruption loan, is that it has to be a viable lending proposition were it not for coronavirus, which is slightly different from bounce back loan, as we'll see in a minute. So it has got to be a credible loan that stands on its feet. And if the banks fear that the loan will not be repaid, despite the fact there's a government guarantee, they're not going to make the loan.
Okay, which moves us on, I think, to the points about security and eligibility.
Yes, so this has changed a bit. So for loans that are below £250,000, there are no personal guarantees. The banks cannot take personal guarantees. Last time at the last webinar, the big four banks had undertaken that, but now none of them are allowed to. For larger loans, the banks can still take personal guarantees. The personal guarantees are not secured on principal residential properties, and the security is capped at 20% of the outstanding balance after the proceeds of assets. So if, for example, someone borrows 2 million, repays, let's say, I don't know, 600,000, there's 1.4 million left, and then they go into default. And if the administrator is able to receive £400,000 of assets from the business to pay the bank, at that point there's £1 million left owing, and the personal guarantee will be capped at 20% of that million rather than 20% of the original 2 million. So that's how the personal guarantee works.
Okay.
The eligibility criteria have become a lot more clear now compared to when it first started. As I said before, it has to be a viable borrowing proposition were it not for coronavirus. They've extended the eligible businesses and membership organisations are now eligible. Pretty much the only things that are ineligible are banks and insurance companies. Companies do still have to have more than 50% of their income from their trade. But if they're sort of renting a property out on the side and it's less than 50%, that's okay. but trade is very widely defined. There are viability tests, which we'll see on the next slide, and they're all measured as at 31 December. That last bullet point is a bit of a red herring. It was right when I wrote it, but since then the CBILS is actually now only for loans of £50,001 and upwards.
Okay.
So here are the viability tests. They define SMEs broadly as companies with less than 250 employees. There are turnover and asset criteria as well, but generally it comes down to number of employees. So for businesses with less than 250 employees, at 31 December, the accumulated losses must be less than 50% of the invested share capital. That is only tested for businesses that are more than 3 years old. I think that's quite difficult. If a company has relied on debt finance and has not got equity finance, has not got outside investors, typically the share capital may only be, say, £100, and it means that accumulated losses at 31 December 2019 cannot be more than £50. Now, for a business which is, say, 4 or 5 years old, that could be very difficult. Lots of startups will be loss-making the first 2 or 3 years, will then break even, and even when they do turn to profitability, accumulated losses might only become profits after 5-6 years. So unfortunately, a number of SMEs that are between 3 and 5 years may be ineligible to apply, and I think that's a shame. For larger businesses, they've got different criteria, and you can see they're up on the slide there. The EBITDA over interest ratio is probably going to be very easy for most businesses to meet, but debt being less than 7.5 times equity might be difficult for those that don't have outside equity investment.
Okay, thank you for that update. Are we seeing, is there sort of a general feel that these applications are getting easier to make now? The scheme is working more as the government would like?
Well, as I said, the number of new applications this week was broadly similar to the number last week, and it was actually less than the number of the week before that. So there's no stampede. I think the reason the number hasn't gone up this week is because of the bounce back loan, which launched on Monday, and we'll talk about that in a minute. The banks still are apologies to any bankers that might be in the audience, but our experience talking to a lot of our clients is the banks are still dragging their heels on this. I'm not saying that means they don't want to lend. It's just quite a tiresome and lengthy process.
And can we help with the applications, Daniel?
We can, obviously, particularly with financial forecasting, for example, because most of the banks are requesting future financial forecasts, and we can certainly help people with that. Obviously, in terms of historic information, we can only really help our own clients with that, but certainly with forecasting, yes, we'd be very happy to help.
Okay, right, thank you for that update. One subtle little point that's raised its head as part of these interruption loans is their interaction with the R&D tax credits. The problem arises because both CBILS and R&D tax credits are so-called notified state aids. These are EU-approved grants that are, to a certain extent, seen as potentially distorting the market. And because of that, you cannot have 2 notified state aids for the same project under EU rules. So the concern has been expressed, what if you have made an R&D tax credit claim and you want a government-backed loan? Are you therefore receiving 2 notified state aids? That could mean that your R&D tax credit claims are thrown out of the generous regime for small or medium-sized enterprises, and you can only claim under the large company regime. And it's not just going forward, potentially this could impact on claims you've had previously. The position hasn't been put beyond doubt, as I alluded to. I think this is a case of a helpful government rushing out support without the opportunity to fully think through all of the consequences. The general view seems to be, and there has been some comment from HMRC, that as long as the loan is seen to be for support of the general working capital requirements of the company, rather than being specifically for an R&D project, you should be okay. But it's not beyond doubt if one impacts on the other. It could be argued if you've had an R&D tax credit claim, that precludes you from getting CBILS support because, as we've said, you've already had one notified state aid. So HMRC is said to be monitoring the situation. One would certainly hope that they will be sympathetic here. And as I say, if you've had an R&D tax credit claim, I think our best advice for the time being is to make sure that any loan support, any documentation prepared does not specifically state that it's for the project, albeit if you only do one thing, inevitably it might be, but it would be better to state it's to support the general working capital of the company. So if we get any clarification on that, of course, we'll put up details, and please have a look at our coronavirus hub on our website where we will let you know. So a quick note on R&D tax credits and CBILS. Moving on then, Daniel, back over to you on the bounce back loan scheme.
Yes, thank you, Anthony. So this is a new scheme which was announced the week before. It was announced last week actually, and came into being on Monday of this week. This is for loans of £2,000 to £50,000, although they are capped at 25% of the business's turnover. And I should stress it is businesses, so LLPs and even unincorporated sole traders are eligible to apply, not just companies, and obviously traditional partnerships. These are sort of CBILS light, if you like. So in this case, the government provides 100% of the guarantee. No personal guarantees are taken at all. Like with CBILS, the government pays the interest and the fees in the first year. However, there's no capital repayments at all in the first 12 months, which is a distinction from CBILS. They've also set a fixed interest rate of 2.5% for the life of the loan. The loans can be up to 6 years, and it's a flat rate of 2.5%, which will apply from month 13 onwards. There are no early repayment charges, so if the business's fortunes sort of go back up again after the lockdown is over, then they can repay in full, and there's been no charge on that. At the moment, there are 11 accredited lenders. I suspect there will be a lot more coming on in the next few days and weeks. And the application is said to be short and quick. There's a 2-page application form. A lot of it is self-certifying, for example, that you're suffering because of the lockdown, and the application is meant to be turned around very quickly. In theory, the money gets into your account within 2 working days from submitting an application. So it's as I said, it's a CBILS light. If someone needs to borrow around 50,000 or less, it's probably much easier and certainly much quicker to borrow under the bounce back loan. You get it quicker, and it's a much more borrower-friendly scheme.
All good. Do you want to talk us through the eligibility rules then, Daniel?
Yeah, so it's eligible for UK businesses. Like with CBILS, that means businesses operating in the UK, so they can be foreign owned, but they need to be UK businesses. They do need to self-certify, as I said, that they're adversely affected by the coronavirus. Like with CBILS, there is this rule that at 31 December 2019, accumulated losses cannot exceed 50% of invested share capital. There is this definition of business in difficulty, and that's how the accumulated losses come in. If businesses are in difficulty, in other words, if the losses at 31 December do exceed 50% of share capital, they may still be eligible for a bounce back loan. It might be reduced depending on which sector they're in. It all depends on state aid rules, which are complicated and also depend on very much on a case-by-case basis, so I can't sort of set them out here. But the point is that if the accumulated losses rule has been broken, all is not necessarily lost. And as I said before, you can't have more than 50% of your income from trading activities. The other key thing is that you can only have one bounce back loan, and you can only have a bounce back loan if you don't have a CBILS or a CLBILS or a corporate finance facility. So it's bounce back or something else.
Okay, right. So that somewhat fills the gap, and I think is certainly aimed at dealing with a lot of the criticism that was raised with the CBILS. We've also got the, the
story so far.
Yes, we have.
So
getting ahead of myself. Go on, Daniel.
So as I said, the scheme went live on on Monday of this week, and on Monday they received 130,000 applications. 69,000 have been granted. We're not sure whether that was the number that were granted on Monday or the number of those 130,000 that have since been granted. In other words, Monday, Tuesday, or Wednesday. But certainly you can see that over half of them have been granted, and they've already lent over 2 billion. The average is 29,000, as you can see. I think the fact that they've got 2 billion in one day compared to 5.5 billion in CBILS in a month of CBILS speaks volumes. It's clearly going to be a much more popular scheme for the borrowers and much easier scheme for borrowers to access. Before we move on, a very quick reminder on all these loans, CBILS, bounce back loan, all of them, that it is still the borrower's liability to repay the loan. So it's not like, oh, I can't be bothered to repay, go to the government and they'll pay you. It is the borrower's liability to repay the loan, and the government guarantee only kicks in if the borrower defaults. That probably means an insolvency process, not necessarily, but it might well mean an insolvency process. So borrowers must understand that they are still taking on the liability, albeit that if they're unable to pay the loan, the bank does have a government guarantee.
Okay, thank you. Now, there's also the large business interruption loan scheme. Daniel, do you want to give us a quick update here?
Yeah, well, this is a new one actually, so it's not an update.
Okay.
And this is because the CBILS is only for businesses with turnover up to 45 million. They always, last time we spoke about the corporate finance facility, which is only for investment grade businesses, and people were saying, well, what about the gap between businesses with turnover over 45 million, but which are not investment grade? So they've introduced, I don't know how you pronounce it, I called it CLBILS, the Coronavirus Large Business Interruption Loan Scheme. So that's for businesses with turnover over 45 million. These are 3-month to 3-year facilities. You can see the limits on the screen, 25 million if your turnover is below 250 million, otherwise a 50 million limit. There are 10 accredited lenders, and again, they're all on the British Business Bank website. Unlike there are similarities to CBILS, and there's lots of differences. So the interest isn't paid in the first year, for example, in the large business interruption loan scheme, but otherwise the government guarantee is still in place and things like that.
Okay. As for eligibility?
Yeah, I've got it. So so again, very similar, as I said, to CBILS, a viable borrowing proposition were it not for coronavirus. There are 2 limits on borrowing. One is double the wage bill for the most recent year, and the other is 25% of turnover, and it's the lower of those, plus the limits that were on the previous screen, 25 or 50 million. The banks are allowed to increase those limits to cover liquidity for the next 12 months at the bank's discretion. But generally, we're seeing that those limits are applying. So the maximum of double the wage bill or 25% of turnover.
Okay. And as far as security goes?
So security, so as we said, 80% government guarantee, no personal guarantees for loans less than 250,000, and exactly with CBILS, for larger loans, personal guarantees are capped at 20% of the outstanding balance after the proceeds of business assets.
Thank you, which moves us on to the Future Fund.
Yeah, so this is another new initiative which has been announced in the last couple of weeks. And the point of this one is that, again, there was another perceived gap in the market for pre-revenue, pre-profit businesses, which are still relying on equity. They might be ineligible for bounce back or even for CBILS because they might fail on the 50% of accumulated losses and 50% share capital test. The idea is these are innovative businesses that haven't yet reached maturity, so they're pre-revenue or pre-profit stage. They have to have had at least £250,000 of private, of outside investment. So in other words, by a third-party investor in the last 5 years. So that's an absolute eligibility criteria. If they are eligible, what the Future Fund does is the government will match funds of between 125,000 and 5 million, as I said, on a matched basis. So there needs to be an investor who will either invest in or lend a sum of money to the company, not the 250 that's already been raised in the last 5 years, but something which is, I'll put in inverted commas, new, and the government will match that new funding. It's a convertible loan, so it's a loan with an interest rate of at least 8%, and it converts at a 20% discount on the next qualifying funding round or sale or IPO. There is a term sheet that is available on the Bank of England website, and although we suspect that there will be changes to the term sheet, it hasn't been launched yet. They're going to launch it later this month. It's not going to be for everyone. Obviously, you need to have had that £250,000 already raised in the last 5 years, and you need to have access to new funding. So it's not going to be for everyone. The terms are not as borrower friendly, should we say, as some of the other funding schemes that we've just been talking about. But nevertheless, this does have a use for innovative businesses which are heavily reliant on outside equity.
Okay, so to be launched shortly.
Yes.
So just to finish off before we take a few questions, as it were, a couple of sort of more personal tax issues, Daniel, and also about protection from eviction. What can you update us on here?
Yeah, so last webinar we did mention that both individuals and businesses do have protection from eviction, in that they can't be evicted for non-payment of rent until the 30th of June. A number of landlords were trying to work around that for businesses by putting in statutory demands or winding up petitions on those businesses for non-payment of rent. Those have been voided until 30th of June. Now, one of them, I forget which one it was, and forgive me, I can look it up. One of them was backdated to 31 March. The other one was only when they announced it, which was earlier in April. And although I believe that statutory instrument still hasn't actually passed through yet, so whether it will be backdated to that date or not, we're still waiting to see. But it does mean that landlords who are trying to put in statutory demands and winding up petitions on tenants who are not paying rent, those ought to be voided. I say ought to be because, as I said, we're not sure what's going to happen to ones that were already done before the government announced this, and also not sure about the time lag until the statutory instrument comes into force. They've also amended the rules of commercial rent arrears recovery, which is another scheme that landlords could use, and that they're now invalid unless there's 90 days of unpaid rent. So it's a bit more protection for commercial tenants from eviction.
All good. Okay, and what about individuals?
For individuals, yeah, so last webinar we spoke about the ability for individuals to have a 3-month freeze on their mortgage and bank loans. This has now been extended. There's now a 3-month freeze on motor finance loans, car loans, which weren't previously caught up by that, and also other types of loans like buy now, pay later and rent to own. There's also a 1-month freeze on short-term high interest loans, in other words, payday loans. The difference, it's only 1 month, but the difference is that no interest accrues during that month. On the other ones, the 3-month one, the interest will still continue to accrue. So when the payments start, they'll either go on for 3 months longer than they were originally supposed to, or the monthly repayments will go up a little bit because there's a bit more interest to pay. They've also introduced some changes on the statutory residence test. That days spent in the UK by people working on coronavirus-related activities are not counted. And finally, a number of people might have seen in the news that there is a life assurance scheme whereby the government pays out £60,000 for NHS and social care workers who very sadly die in the course of their frontline essential work.
Okay, thank you for that. So that's the update. As I say, by all means, do download and listen to our previous webinar if you missed that last time or liked it so much you'd love to hear it again. We're now going to move on and deal with some questions. As I say, apologies we didn't get a time to address all of your questions last time, but we have downloaded them and we'll try and take as many of those as we can now, plus some of the questions that you've kindly typed in today. So team, if you all are all ready as question master, and I'll keep you on your toes here, various questions. Chris, if we could start with you perhaps. Daniel just mentioned the point about the statutory residence test. There is a concern that people may be stuck in the UK due to exceptional circumstances. The legislation in ascertaining whether you're resident does allow an extension of the number of days you count in the UK in exceptional circumstances. Are you able to give us a quick update there? Because a couple of people have asked about how those rules apply and whether there are any plans to extend them further.
So at the moment, we're not aware of plans to be extended any further. The legislation remains unchanged in that sense, unless, as Daniel's alluded to, that the individual is working on coronavirus-related activities. It's maybe a little bit of watch this space on it. I mean, the current 60 days, given that we were at the start of the year, takes us up to the 4th of June. And maybe it's a watch this space, see what happens with the announcements with us being released from lockdown and so on. Yeah, I mean, it would seem if we are still restricted on travel, etc., beyond the 4th of June, you'd like to think the revenue would announce something. But at this current stage, no is the answer there. There's been no announcements on it.
Okay, so again, do keep an eye on our website and in particular our coronavirus hub, where we will make sure we keep you all up to date. Now, one of the vexing issues with the job retention scheme has been with individuals and in particular directors who may be on an annual payroll. So typically directors, for all good tax reasons, may take, for example, Chris, £8,500 a year to get their pension stamp, etc., and typically remunerate themselves by way of dividends. All good. However, the question's been, if you submit an annual payroll on, say, the 18th of March, you would be entitled to make a furlough claim with HMRC. But if you submitted one on the 20th of March, you wouldn't, which I think is correct, isn't it, Chris, first of all? And then is there anything we can do about this?
Yeah, I feel the bearer of bad news on all these questions, Tony, but that is correct. The emergency legislation is clear on this point, that there has to have been a 1920 payroll run prior to the 19th of March. So you run on the 20th of March, they do not qualify. In terms of an appeals process, no is the answer. There isn't one at this stage. Will something happen going forward? I don't know. I doubt it in this instance, because the guidance is clear and the revenue are phoning round and answering this query in mass now. Where we've raised the query before a number of times, they're phoning and answering. So no is the answer. I don't think it's going to change.
Yeah, I mean, it's just unfortunate, isn't it? To be honest, I think it is. It might be seen as a little unfair, but I suppose from HMRC's view, there has to be clear rules and a cut-off.
It's purely because of the fraud element from HMRC. It is unfair, but from a fraudulent point of view, the number of payrolls that would have gone in post 19th of March, it is what it is. It is unfair to those that have been on payroll for years, but there's nothing we can do.
All right, thank you for that, Chris. Wendy, one for you. Thank you for your question that goes as follows. I think this is from Donna. Can you provide clarity on whether an employer can re-employ an ex-employee who's been furloughed if they intend to continue their if they have no intention to continue their employment in the future? So
yes,
Wendy?
yes, the answer is yes. And if you're considering re-employing an ex-employee for the purpose of furlough, it's really best, if you can, not to allow the end of the contract to be reached, or the end of the notice period to be reached, and rather to extend the individual's terms and conditions. But you need to think about whether or not they're eligible, and it might be a bit late for this now, but you can only claim, as Chris has made clear, for employees that were on an RTI pre-19th of March 2020 and who were on the PAYE payroll on or before the 19th of March. If you do that, you might want to consider agreeing different terms and conditions with the individual for these purposes as well, so that they're not receiving a full suite of benefits. For example, just bear in mind that the longer somebody's employed with you, the more liability there is against an employer, quite naturally. So you'd have to weigh up all those factors when considering doing that.
Okay, thank you. Chris, back to you. Don't worry, Daniel, you'll get your chance later. My client is a Spanish company with no UK tax presence, but it does run a payroll to pay the UK sales representative. So we don't have a permanent establishment, but we do have an individual referring contracts back to Spain. Will the Spanish company be able to make a claim under the coronavirus retention scheme if that employee is furloughed? Chris?
Yes, on this one, it's positive. The rules, the eligibility rules are that there has to be an entity that has a UK payroll. So from that sense, yes. The one bit I would mark is that they have the claiming entity has to have a UK bank account. So assuming they meet that criteria, then yes, you're okay to claim. We have seen on the claim form that the revenue are allowing, if there's not a UK business account, they do appear to be allowing a personal account that it can be paid into. So as long as there's a UK account of sorts where the money can be paid into, then yeah, I see it as that's okay.
Good. I think that was the answer I was hoping for. So I think the point is there, you don't have to be a UK incorporated business to qualify for the furlough scheme. You merely have to have a UK business and be paying staff under PAYE. So all good. Wendy, back to you. Can furloughed staff get a part-time job with another company?
Yes, they can, as long as it's not connected to the furloughing employer. You will also need to check your employment contracts, because many have clauses that actually prevent individuals from working for other employers. If you're keen to allow somebody else to do this that's in your company, you might want to change the terms and conditions temporarily to allow this. But just bear in mind that there is a risk that the individual may not choose to return to you post-furlough, and think about any training requirements that may play a part in the original contract. So you need to remind the individual of their obligations to fulfill their training requirements. So again, yes, you can, but you need to think about it carefully before you agree to that.
Okay, thank you. Daniel, you still with us?
Hello?
He's gone very quiet. Oh, you
No,
are still
I'm here. I'm here.
Good. Just thought I'd check. We didn't cover business grants today. We did cover it in some detail last time. But one question that's coming on the business rate support is businesses operating from home, are they eligible for any grants? Which is a question that's also been asked today by Paul.
Yeah, unfortunately, the answer is no. They need to be commercial premises, and there are certain complex rules in place where a property is sort of joint residential and commercial, but the general rule is that business operating from home are ineligible for these grants.
Okay, thank you for that. Chris, back to you then. How does the refund of NIC get calculated if you receive the employment allowance, which is 3,000, really gone up to 4 now?
Yeah, this is a good one. So I spoke to the revenue on this particular point because obviously we're at the start of the tax year, and how do we take into account on the claims? And the revenue were fairly good coming back. They said you can take it into account on your calculation. So if you know you have you're going to use the whole allowance up or part allowance out on your claim, then you can take it into account there. The BK have taken the practical approach of not including the employment allowance on our calculator, and essentially hoping, or we're assuming, that a lot of payrolls, when we come out of this scheme, will still have enough NIC liability to utilise the allowance there. We checked with HMRC and they said that approach is absolutely fine. Keep your workings, so keep the calculators for each individual month's claim, and it should be clear later down the line, so your payroll software should be able to deal with that as well.
Okay, thank you for that. Further question for you that's come in from Ian, who's sent us another question this morning. We'll get on to if we've time. If I furlough myself, can I still apply for new contracts now that my contract has finished?
Assuming that means as a director of a limited company, then back to before you can furlough yourself, be careful of the point with the pay dates, whether you're on annual payroll or monthly payroll. Are you eligible? Well, you can't carry out duties of the company unless it's within the Companies Act. So if you're looking for new business essentially, or engaging with a new provider, then no would be the answer. You can't carry out those duties whilst being furloughed. So do be careful. That, I mean, the guidance we're giving is we're being tight on even on answering emails, which is a tough one as a business, sole business owner. That, you know, your emails come into your phone, so you know you're going to see them. It's going to be very tempted to respond with, but you know, maybe put an out of office on, or maybe standard response to say I'm on furlough and unable to respond until a certain date. Are the revenue going to be able to track that? I don't know, but the answer to the question would be no.
Okay, thank you. There's a couple of related questions to that. One we sort of touched upon in the last webinar. My business is trading with just me working. I assume this is a director. Do you have a view on furloughing my partner? I assume this means if you if you engage your spouse as a fellow director as well, for example. Do we have a view on whether you can furlough spouses who are also officers of the company?
This is there's different views on this. I mean, the point we've seen a number of occasions is how much work is actually the spouse doing for the business. Now, if you are putting through a payroll for that spouse, presumably they are doing work for the business, or it might be little, but if you put the payroll through, then one approach could be, well, would the revenue look favourably if you don't claim? Because, you know, are you inadvertently saying this my wife doesn't do any work, or my partner doesn't do any work for the business by not claiming? I mean, maybe not, because your business might not be affected. So I don't think the revenue would take the negative approach if you don't claim. So it's really, you have to look at the circumstances and see, well, is the individual carrying out work for the business, and has it been affected by the corona? And if the answer is yes, and you put through the payroll, then I don't see why not to claim. If we're suggesting that they haven't done any work, then I'd look at why you were putting through a salary in the first place.
Yes, I mean, it does raise the question as to the tax deductibility of that salary historically. I think the other point is typically they'd likewise be on maybe £8,500 a year, and so any claim would be relatively modest anyhow.
Indeed.
So, okay. Related again, I think perhaps one for you, Wendy. If you are furloughed after the period, do you still remain as an employee? I think there's a definitive answer to that one.
Yes, and unless you've actually served notice on an individual or gone through a consultation and confirmed a redundancy after a consultation period while somebody's on furlough, yes, they're still an employee. And employers should really be issuing agreements both to put people on and off furlough, and informing them of the requirement, the need for them to return to work when an employer needs them to do so. It's again about having an audit trail for HMRC. Just throw that one in there as well.
Yeah, I mean, the question is, after the period you remain employed. I mean, you remain an employee during the period of your furlough legally, don't you? Albeit you can't work. As Chris said, you need to be careful even receiving emails. Training is allowed, but I think the revenues guidance does talk about doing sort of something profit generating for the business, but one should be careful, and I know it may be sensible to restrict email access, as we alluded to before. So thank you for that. Chris, what if your 80% wage is more than £2,500? Who will pay the balance?
Well, the point is, it's a discussion as to whether there is going to be an excess that's paid. It's depending on what the agreement is. If the business have agreed with the individual that you're just taking 80% and it's above 2.5, then the business, to make the claim, the revenue are clear that you will only be able to claim for up to 2,500, whichever is the lower.
And it's up to the company whether it wishes to pay the balance, isn't it?
Indeed, it's up to the company. I mean, the whole negotiations originally with an employee where you're varying a contract is the agreement between the two parties.
Okay, all right, one more for you. It's most of these questions about the furloughing scheme, aren't they? I think it's where there's the most number of nuances, so it's not a huge surprise. Can your employer deduct holiday allowance from furloughed employees during the period of their furlough?
Wendy, do you want to pick?
Yeah, so there's a few questions. There's questions about annual leave while somebody's on furlough. So an employee can take, I'm going to answer it in a slightly different way. An employee can take and be paid at the normal rate of pay for holiday. So they're not paid at the furlough rate if they choose to take holiday whilst they're on furlough. And of course, employers can refuse requests for annual leave during furlough, but you have to give the appropriate amount of notice as listed in the Working Time Directive. And as you're probably aware, employees can now carry forward up to 4 weeks of annual leave into the next 2 holiday years where it's not been reasonably practicable for them to take it because of the pandemic. The one thing that there's really not clarity on is whether or not an employer can require an employee to take annual leave during furlough. So I would suggest that you keep furlough and holiday separate where you can, and give notice to employees to take holiday post-furlough where appropriate. But the big message really from me is that you need to strictly plan and monitor holiday usage for the rest of this year, but also the following year, so that you don't encounter any operational difficulties.
Okay, thank you. Time marches on, so we'll just take a couple more of the questions from last time before I throw a couple of questions at the team that have come through today. Chris, are the profits for the self-employed income support scheme before or after the capital allowances?
That's after capital allowances. So
Okay.
yeah, very simple. It's essentially the top line of a tax computation. Taxable profits is where the revenue are taking it from. Just to stress, the revenue are doing the calculations on this. So it's not one for accountants to potentially get involved. I'd leave it to the revenue and then check their calculations after.
Okay, and one more for you. If you are employed and also have a self-employment, can you get paid under, well, both schemes is the question,
Yeah,
the job retention and the SEISS?
if your criteria fits, I've seen one case that they apply, they will cover both, and they've also successfully got a business rates grant as well. So yes is the answer.
Okay, one I will attempt to address that came in last time, which was my favourite question. What if you furlough an individual and they have EMI share options? Now, the point that was made here, under EMI, you have to meet the working time condition. Broadly, you devote at least 25 hours a week or 75% of your working time to the company. If you are on furlough, does that potentially mean you lose the benefits of your EMI share options? Again, I think this is a case of well-intentioned legislation having unexpected potential consequences. I think the point is there, when it talks about 75% of your working time, I think the view is you look at the average over the year. So even if someone has been furloughed for a period, one would hope that they still meet the 75% of their working time condition. One would also hope that HMRC are somewhat sympathetic. And certainly legislation does talk about if you're on maternity leave or similar, where you are perhaps unexpectedly out of the office, they may put the position beyond doubt by just tweaking that phrase to address that. So we are hopeful it shouldn't interfere, and that would seem only equitable. Can't give you any absolute guarantees, but hopefully we can give a little bit of comfort that there should be a get out there. So let's just have a look at what's come in today. Daniel, one for you from our own friend Stephen. Hope you're well, Stephen. Do get in touch. The Future Fund. I understand that if the loan was not repaid, there could be a penalty of up to 100%. Is that true? Daniel, does that ring any bells with you, or is that something we'd have to check?
That is something which we're going to have to check. No, that is correct. That is correct. If it's not repaid and it's not converted, there is a 100. That's exactly correct. Yeah, you have to pay 100% penalty. Yeah.
Right. Okay. So thank you for confirming that, and Stephen, thank you for your question. Paul asks, if you don't have a government gateway account, I understand you're encouraged to apply for one when you are actually making the SEISS claim. as part of the authentication process? Or has this requirement been waived? Paul would like to clarify. Chris, can you help us out here?
Yeah, you do need the government gateway account. You don't need to do it as part of the process. Do it now. Well, let's finish the webinar and then get online and apply for your government gateway, register for the business side of it. I believe the revenue have removed the restrictions to receive a code in the post. You should be able to activate straight away. So do it in advance of the claim.
Okay. Lynn has flagged up the bounce back loans. Daniel, you touched upon the fact these are also state aid. So Lynn is asking the entirely sensible question. Well, you made the point about R&D tax credits and notified state aids. Do we potentially have a problem with the bounce back loans? I think the answer to that, Lynn, is probably yes. I haven't looked at the point, but I think the principle is the same, isn't it, Daniel? Have you anything to add?
Yeah, no, I don't think it is the same actually, because of the de minimis limits. My understanding, and forgive me if this doesn't turn out to be correct, but my understanding is that as long as you're not a business in difficulty, because you're borrowing less than 50,000, you're not caught by the state aid rules. They'll only kick in if you're a business in difficulty, and then you may, as I said before, you may be able to borrow less or not borrow at all. And it's because of the size of the loan. So they are an issue for CBILS.
They're not. Okay.
Yeah. Yeah.
All right. Thank you for clarifying that. And I'm just having a look through the rest of the questions. I'm interested in the bounce back loan and the ongoing liability should my limited company not return to trading. Daniel, any comments on that?
All of these loans very much are for businesses which are still trading and which one hopes will trade after the pandemic is over, but which are suffering because of the pandemic. So if a business is not viable, or if it's clear the business will never become viable again because of the pandemic, then one can understand that a lender is not going to want to lend to them. So, you know, but one hopes that eventually, I mean, there may well be a recession coming. I think undoubtedly there will be a recession coming.
Yeah.
But once that recession is over, and God knows how long that will be, hopefully we'll be back to better times, and businesses will also be back to better times. And of course, I accept the fact that the recession might last longer than the length of these loans. But I think at the end of the loans, the banks will have sensible conversations with the borrowers. But you know, at the moment, the only criteria is that they are still trading businesses, and that would have been viable to borrow were it not for the pandemic.
Okay. Final question from my old friend David. How can you correct an incorrect furlough claim? I mean, David doesn't tell us exactly what's incorrect, but Chris, can they be amended?
Yes, well, two ways. The revenue will take an amendment over the phone if they haven't processed the claim and paid it. So getting quick if you have made an error on the claim and call them up. Secondly, the revenue are happy to make an adjustment in a later claim as long as your workings are kept and what you've done. So if you've overclaimed, reduce the next month's claim. Equally, if you've under, then make the adjustment. But I would stress on that it's very important you keep the workings, because the revenue could easily reject a claim if it's substantially greater than they've expected. So you may have to then make a call on the second claim. Don't know in terms of the final claim, if you make an error on there, what's going to be the case. I suspect it's going to be a phone call. There is no digital answer, so you can't log back in and make the repair. But the revenue, I wish, again, the revenue are being quite sympathetic to this. They appreciate there's going to be errors that are made, and they're being reasonable when dealing with things over the phone.
Okay. I'm sure it was a purely hypothetical question from David anyhow. Right, thank you all very much, team, for answering those. Thank you all for sending in your questions. Finally, do look away. Those are our mugshots and our contact details. If you've any further questions, do feel free to get in touch. Thank you very, very much for joining us. We will be sending out a copy of the webinar and the slides to you all. If you have any further questions, do get in touch, and do, as I say, keep an eye on our coronavirus hub, where we will endeavour to keep you all up to date with any further changes. So we're all eagerly anticipating the government announcements tonight to see what changes to lockdown there will be. In the meantime, do keep well, do keep safe, do keep in touch, and thank you again for your time. Bye-bye now.
Bye.